Hey everyone, welcome back to another episode of Stage Debate with Cost Seg Isaac. I'm your host, Isaac Weinberger. I'm a cost segregation specialist. Connect with me. I love to chat with you, real estate, cost seg, and anything in between. Today's episode number 8, we have some great folks on, Ben Spiegel, Raj Tirur, and Steven Weinstock, all friends, clients, just great guys in the space. I'd like to give a shout out to our episode sponsor, a friend of mine, Philip Manicherry, all the way from California. He's worked with so many top owners and elite owners in the multifamily space, renegotiating new contracts for telecom services, really putting a lot more money into owners' pockets. This is something that every single owner of any multifamily property should do. Reach out to him. He won't charge you until he gets the money for you. Renegotiating services like Wi-Fi, phone services, etc. This is the man you should be talking to. Obviously, thank you so much to our corporate sponsor, Michael Stern of Line Star Tax and LSD Consultants. What a guy in the space. Outsource CFO services. But aside from that, and most importantly, leasing and collection teams. So if you have a property that's having a hard time getting leased up, you have a property that just the collections are not going as planned, and obviously that's hampering returns. These guys are experts. Just their experience in the multifamily space is astounding. They've done so much work, so much great work in the space, and definitely folks you should reach out to. So guys, tune in. I'm excited. It's going to be an exciting conversation about these folks' journeys, their takes on the market, and more. So let's go. Hey everyone, welcome back to another episode of Stage Debate with Cost Seg Isaac. Today we are joined with some really special folks in the industry, 3 great friends of mine, Steven Weinstock, Ben Spiegel, and Raj Tirur. Some of these folks are savage closers, closing deals all day. I'm thankful to know you guys, to deal with you guys on a daily basis, call you guys friends. Appreciate you guys taking time out of your busy schedule to come on for a little bit and share with the crowd, with the audience, your experience, what you guys have done to get to where you are today, what advice you would give in today's industry. Obviously, rates are starting to come down a little bit. We'll talk about that. But first and foremost, I'd like for everybody to introduce themselves for a minute or two. Steven, let's start with you. Just introduce yourself, what you've done, where you're holding, the name of your company, and what your goals are.
Sure. Steven Weinstock. I live in New York, Brooklyn, New York. I've been in real estate since 2001. Started with some smaller assets locally in New Jersey, small multis. Last 7 to 8 years, started raising some outside capital to purchase multifamily, primarily in the Cleveland suburbs, Louisville, Kentucky, and parts of New Jersey. My company is called We Capital. That's me and a partner, Michael Eisner. Isaac knows us pretty well. We've done some cost segs together, and looking forward to discussing.
Thank you, Stephen. And yeah, you guys have done some nice deals in Ohio, Kentucky. I've seen some of those deals, impressive deals. You keep doing nice deals. I wish you a lot of luck. Ben, one of those guys that just, it's another week, it's another closing. Super impressive what you've done, what you continue to do, what your goals are. Share a little bit about what you've done, what your goals are. Where do you buy? What do you buy? Let's hear it.
Yeah, so I'm Ben. My firm is Redwood Capital. My partner is a guy named Matt Rinklin. We come from a more investment banking, private equity, hedge fund arena. We try to take that approach to real estate. I started buying buildings with my bonus money while working at these hedge funds, and have since rapidly expanded into what I like to call special situations. I'm asset agnostic. We'll really look at anything and everything from a multifamily to an RV to a trailer park, RV resort, or a coal mine, as long as the cash flows work. Right now, I'm bullish on really micro geographies within the Northeast, but primarily the Southeast, and most notably Southern Alabama and Southern Mississippi. I'm launching a $50 million closed-end fund, of which is almost fully raised, to continue purchasing trailer parks and RV assets in those areas.
Thank you, Ben. Raj, tell us a little bit about yourself. I've known you for a while. White Paper Strategies. You guys don't play any games. You guys are taking down property after property. Fill us in.
Yeah, absolutely. Yeah. So I'm Raj Tirur. of white paper strategies. Been in the game for roughly 15 years at this point. It sounds like forever. It feels like forever for me. Started, I was in corporate finance after college. Started investing in some smaller multi, kind of just attracted to the yields at the time, and it was a little bit of an iffy time of where we were historically, economically, and real estate especially. So diving into that time was opportunistic, and through that I was kind of able to learn a lot of the stuff that I still treasure to this day, which is diving into the workforce housing space. That's still where we are. It started off small again, where we're buying smaller multifamily in the central Massachusetts area where we're originally from. And that kind of just snowballed. We went a little bit outside our comfort zone and into some of the Southeast markets, had some cycles in South Carolina where we had some entrances and exits, raised some money for a couple larger deals there. And then we brought it all back to Massachusetts where we feel the most comfortable. Kind of where we pride ourselves in is we'll take money for some of our deals that we're doing now. But a lot of it is our capital, and we are trying to open it up to outside investors. But what we always felt is necessary is to really have an understanding of the market that we're in, to really feel like local players. Even though we own close to 500 units now, we want to have that presence and want to know a lot of the local business owners, understand what the town is really looking for to progress the town, to get better people in there. And so that's what we pride ourselves in. And with that comes the success of the operation. So from where we started to where we are today, and really just kind of trying to make the places that we're in successful. And that helps us get deals. It helps sellers and people kind of looking to exit in their markets find us, keep a vertically integrated system with knowing a lot of the local handymen and whatnot in the area, kind of wrapping up their group, bring them into ours. It's really bode well for us to keep costs down while, again, still making sure that we're bigger players in the markets that we're in. And that's kind of how we see success for us and how we're able to then parlay it to some of our investors.
Love it. Very, very impressive. I've seen a lot of the work you've done, Raj, and these are good deals. Transact to transact. You find the good deals. Ben, let's start with you. You have a background in investment banking. It's no secret that you have some high profile investors that invest with you. You're definitely, I wouldn't call you a capital raiser because you're an actually owner. You're doing the real hard work. But at the same time, when it comes to capital raising, you have some great guys investing with you. And my question to you is really twofold. First and foremost, having that investment banking background and the private equity connections, is that something that technically gives you an edge over other guys in terms of capital raising? And on top of that, why do you like the fund model more than the regular classic syndication model?
Yeah, so I guess to start off with the first part of your question, I believe that just having the unique background that I have gives me somewhat of a competitive advantage in that I am able to underwrite a situation a little bit differently. As I said, I'm asset agnostic, whether it's multi or medical or industrial. I'm a true bottoms up cash flow analyst based really kind of investor. And I really try to drill down like what Raj was saying, like he wants to be like, well, I get what he was saying. Like I want to be a big fish in a small pond. I want to get intimately familiar with the markets that I'm investing in, because at the end of the day, that's really the only way to get a competitive advantage. And in regards to the capital raising component, why I am choosing to move to the fund model over the syndication model is really obvious. I mean, if you ask me, I've done dozens of syndications before, and they're difficult. And basically, when you're doing a syndication, you're signing a contract that you can close, but you don't have the equity raised essentially yet. And it puts a lot of pressure on you to lock up that capital. And there's always stragglers, or there's people that commit that fall out for a myriad of reasons. And I feel once you get to the point where you have a track record that warrants the ability to make a fund viable, it's a much more scalable and institutional strategy.
Right. I totally hear that. My follow-up question to you would be that are funds only applicable when it becomes sort of institutional, semi-institutional? Because technically, if you have a guy investing small cash, 100 grand, 200 grand, 300 grand, he wants to look by a deal-to-deal basis. Unless he trusts you 5 million%, that he's going to put money into your fund, and whatever deal you bring to the table, he knows for a fact it's going to be a solid deal. And again, we're the institutional guys, we'll see that. For a smaller guy, is there a fund model structure that is possible to work?
I believe so. If you tailor the investment parameters very specifically to a specific mandate of what you are going to be investing in. So, for example, this fund is solely going to be targeting trailer parks and select RV park acquisitions, restructurings, and expansions in Mobile County, Alabama, Baldwin County, Alabama, and Harrison County, Mississippi, and maybe selectively Pensacola, the Panhandle of Florida. But I believe that if you have a very focused micro strategy and clear defined investment parameters that you are going to keep, that helps to get a prospective accredited and non-institutional investor over the hump. Especially if you can show them case studies of what you've done in that area before and say, we are just going to be doing this again and again and again. And it really drills down to, we will not buy anything that is 5 miles away from a major freeway with X traffic count. We're within 10 miles of a Walmart. It is very specific in terms of cost, maximum cost per pad. And I feel like at that level of specificity, it can help investors get over the hump. But I do understand completely what you're saying in terms of investors having ambiguity just to blindly trust you with their capital to invest, especially if it's not a warm body referral relationship and it's a cold introduction.
Understood. I love it. Steven and Raj, what's your take, fund versus syndication model?
Just a quick question for Ben. Sorry, Raj. What percentage of investors to a fund would you have are institutional investors, and what percent is family and friends or smaller checks like Isaac mentioned? Just if you can give me some numbers on there. I'm curious.
Yeah, so for this vehicle, of the 30 million closed end, I'd say about 75% is of the million plus, and 25% or less is below $500,000.
But you would say experienced investors, people have invested in the past, gone through cycles?
Not really. I'd say a lot of them are ultra high net worth guys, whether they run a hedge fund out of London and they're making $5 million a month and they just want to put some money to play, or the professional athletes, they love the space, or they're a very small pension fund or an endowment. But I do want to be clear that we welcome and we rely on the sub $500,000 check size as well, and because at the end of the day, it's all about relationships, and you need to continue to form new ones and grow your Rolodex. And we are heavily reliant, even though for this fund the majority of investors are not, that we are heavily reliant on building up that base.
Got it. Would you recommend the fund model only after having done multiple or dozens of syndications, like you mentioned?
So, I'll give you an example. I just closed an $8.5 million acquisition of a mixed-use building in Milford, Connecticut about a week and a half ago. $5.5 million from a life insurance company, debt side, and about $4 million of equity. And the equity came primarily from one anchor investor, which was a family office out of California, through a trust. And it was probably one of the most arduous deals I've ever done. Came down to the wire, spent well over $100,000 in legal fees, and it kept me up at night, whether or not, and it was also a 1031, so there were elements of that involved. A good way I like to put it is, I do not want to go hard on a deposit unless I am 90% sure that I have the capital locked up to close. I think that's a good rule to go by.
Raj, what's your take on the fund versus syndication model? And then I have a follow-up question for you.
Yeah, absolutely. So, Isaac, as you mentioned, the deals that we do and when we transact, we don't just do it to transact. We want to make sure that these are strong, solid deals in markets that we know and trust and that we've been there for a long time. And we kind of see, we've been through these cycles before in our little markets, and we know what to expect going forward. So whether it's a deal that we keep in house or we raise for, we kind of understand what that's going to look like. We feel very confident in that. Now, we've done a few syndications in South Carolina, as I mentioned, and to Ben's point, it's you put it under contract, and then it just puts a lot of pressure on you to raise. It can be tough. It can be very stressful. In a fund model, which we haven't put together a fund. I worked for a fund, back in the day, single family REIT that specialized in Ohio, actually. But from learnings there and kind of what we've started to do is, without classifying it as a fund, we'll have the money and the deals kind of rolling hand in hand. And so when we do get in, for us, we're going to be doing, deal sizes of 20, 30 unit portfolios that we're going to be raising for. And we already have committed investors. And so we kind of are just piecing those two together. Deal comes up, money comes up, deal comes up, money comes up. And we have a good network of investors for that. So, think of it as a mini fund, I guess, if you will. To me, it makes life much more easier to say, I have a deal that I'm looking at. I know exactly who I'm going to go to for it and get it done. Or we look at a deal and we keep it in house. If I'm looking at a bigger deal, we want to make sure that we have, again, to Ben's point, we don't want to lock up that money unless we know that deal can be raised. Otherwise, I'm not going to put that kind of pressure on ourselves. And again, we've done it before and we've been successful. It's just understanding what those risks are. And the further along you get in this game, I think that you just have to be a little bit more risk averse than we once were, and that's definitely holding true for us. So I like the fund model more, and I think that as we kind of grow in the space and get more, the confidence is there, and to now just get that money list and then kind of put something together, I think would be the next step for us, and it would be more fun than syndication.
All right. Just to plug myself actually for a second, I don't usually do this on the podcast, but I'm dealing with a fund, an industrial fund out of Wisconsin. And in terms of depreciation, it actually helps out, because if you have a guy that invests in one deal and then you give him depreciation from a different deal to add on to his depreciation from that deal, it can get a little tricky. But when you have a fund model, it's much easier because you're investing in the fund, and the fund has X amount of dollars of depreciation from all these deals together. So just on the depreciation side of things, it could make things easier. That's my plug for today. Raj, question for you, and then I want to hear Steven's thoughts on it, and that's bad. So you guys knew this question was coming probably. Interest rates dipped a little bit. Everybody's talking about it. Every other post on LinkedIn is about the 50 bips. How does that affect your strategy? Does it affect it? I'm assuming not. It's almost the same, but one little piece of food for thought, the fact that it is dipping a little bit, does that show that it's going to happen again soon, and then ultimately it changes your refi plan and it changes your ultimate strategy? Let me know, Raj.
Sure. So did it affect me in acquisitions, let's just say 6 months ago? Where is it at now? I'll say it, and I'll say it over and over again, is that real estate is hyper local, and we've chosen where we are, and I don't let a lot of the noise bother me. In fact, I really try to block it out. I joke that I won't even watch the news. I honestly don't even care what's going on, when Powell's next news cycle is and when that's going to be, because if I let that affect me, then I'd be sitting on the sidelines and not doing deals that I've done, and I'm very happy that I've done. When you're talking relatively small dips like that, the people that I'm buying from, typically it's a situational based thing. It's not, the rates drop, so the price is going up. If that's who I was buying from, then again, I'm going to be paying retail prices. We pride ourselves on buying at a discount, looking for distress, whether it's in operational issues from the current management, whether it's from a property being distressed, or whether it's people that are retiring. And in the markets we're in, they know who we are. They know who to call if they want to get a deal closed, and they know the white paper can do it. So and if they're retiring, they're not going to be expecting us to pay a hefty price for it. Otherwise, they would list it themselves, but they'd rather not do that. They want a quick close. So, it doesn't affect us that much in that realm. Where do I see it going? Yeah, I think that we can expect a few more. I do think that we'll normalize a little bit. And how is that as far as the refi angle? That's something that we, again, even on these larger plays that we're doing, we look at if we're raising for something, if it's for a fund, we look at an exit, a full-on exit, or if it's stuff that we're holding in our portfolio. I used to do a lot of refinances to unlock capital and move it forward. But now, again, we own a lot of this portfolio just in-house. So the cash flows are strong enough where we're able to just buy up, whether it's the smaller deals or the mid-sized portfolio deals with our capital. I don't want to continue to leverage and over leverage. It's something that I think a lot of investors, including myself, we had to do it to get the ball rolling. And then kind of once you normalize and you feel good about where you're at, delevering where you can, using cash flows to buy at healthy leverage on future deals. And yeah, really not let the noise affect you. That's at least how we look at
Love
it.
it. Awesome. Steven, what's your take on the rate cut?
Sure. So I'm going to echo a lot of what Raj said, maybe with my own little spin to it. I'm always in acquisition mode. The rates just make things a little tougher sometimes, but I'm always looking to buy. But at the same time, I'm not a factory, so I'm not just closing deals left and right. And, I find the deal, and like Raj said, a lot of them are situational. Maybe it's not listed. Somebody reaches out to me, do a lot of networking, and deals somehow find me. And again, those deals are not based on a rate or something specific to Jerome Powell, like you said. At the same time, obviously, I'm optimistic. I wish I lived in a little of a news bubble like Raj. I don't. I'm always looking at it. I'm hearing it. I'm reading it. But at the same time, it's not really affecting my acquisition strategy. As far as refinances, we're always looking to unlock capital back to the investors. Most of my investors are through straight syndications. And I'm always looking to get the capital back to them. So yeah, I will be exploring, just see what's going on based on the rates, and I'm very excited about what happened last week. It doesn't make me jump up and down all day long, but I'm hoping it's trending better for not just for my personal portfolio, but just I think it's good for the economy in general if we do see another cut and then hopefully another one after that. But again, back to my acquisitions, I'm always buying. I'm doing this a while. I was buying in '07 and '08 and '09 and 21 and 22 and 23. So, if the rates go down, it's just another tool in my tool belt. But I am excited to see it finally trending.
Yes, one thing I will agree with on Steven is that you're probably one of the biggest networkers I've seen, and it's truly unbelievable. I thought that I go to a lot of events. You're just going to events, meeting people, meeting brokers, meeting potential investors, meeting vendors, talking to vendors, being nice to them, and never know where that value will come through. And I appreciate our friendship. Ben, tell us your view on the rate cuts, and I want to hear a little bit about your acquisition last week, a little deeper dive about your acquisition.
Yeah, so absolutely. I mean, I feel so how I've felt over the past 6 to 12 months that any deal you could buy that actually pencils out and makes sense is worth doing because it inherently was an interest rate arbitrage play. If the deal worked with when you're borrowing at 7.5%, it's going to look a whole lot better when you could refinance with that at 6.5 or 6%. I bought some deals in Greenwich, Connecticut, where I'm from. Earlier this year, my borrowing rate 7.5%. I'm going to refinance those immediately. Diving into the deal that I just closed on 10 days ago, I rate locked 3 or 4 months ago with I guess you could call a soft bridge loan from Midwestern Life Insurance Company, 8.7, in the mid to high 8% range with no prepayment penalty, 59% LTV. And it's a very unique acquisition because 40% of the commercial space was vacant and not even advertised for rent. We own a myriad of buildings in the Milford area where that building is. And we've acquired it at 7%, so a little bit over 7% cap rate, NOI about $600K at close. And, we already have LOIs in to lease the majority of that 40%. Just doing that alone will bring our NOI from 600 to 760. So once those tenants are moved in and T&I is done and they start paying rent, we will be going for a refinancing and hopefully taking out at least 50% of the equity. And I mean, that's going to be within 6 to 9 months post-close. Obviously, it's a very unique, special situation. But then on top of that, with the 32 two-bed, two-bath duplex apartments above it being rented, 30-40% below market, 13 of which were unrenovated. As the tenants turn, you renovate them, aesthetically 10-12 grand. re-rent at market for, $2,800 versus $2,200. That alone, that gives you another 150 in NOI boost. So all of a sudden, you're over 900 versus a 600 in purchase. So, and I buying at a 7. So, I mean, basically on a 12-month run rate, the building on a conservative basis is worth over 14 million bucks.
Wow. Wow. I like it. And you said something in terms of the debt that that you secured was from this life insurance company. To be honest, this is coming from a place of ignorance. I'm not crazy involved in the debt market. Is that common?
It depends. It depends on your mortgage. If you have a mortgage broker, what existing relationships you have. I mean, life insurance companies, just like banks, they take money in. They have to make a spread on that, on their premiums. It is fairly common for life insurance companies to lend, and the benefit of going to a life insurance company over a traditional banking institution is they are a private lender. So they do not have the robust checklist and the arduous timeline that a typical bank has in order to close. They can close quicker. They're able to be more nimble, and especially given the size of the life insurance company, that has an effect as well. But yeah, I'd say it's less common, but it can be used very advantageously.
To me, it sounds like it's similar to preferred equity to a certain degree. Obviously, you're placing it as senior debt, but it sounds like you have like less red tape.
Yes, exactly.
Yeah,
Cool.
Isaac, to jump in, I had a loan a couple of years ago, also with an insurance company, but it was arranged through a broker. But it was a Utah-based insurance company, and like Ben said, less red tape. It's a fast closing. Although they were very strict, ironically, with my insurance on the property, and they really increased my what I underwrote from the previous from the seller. And the broker that they were using, they really, just made me get like extra insurance. Ben, did you have some of that as well?
Yeah, I think part of the problem is that they're not local. This one's in Wisconsin, so I almost feel like they have internal. That's the maybe one shortfall, that they have these internal policies that they feel like they need to overprotect themselves. I mean, we had to get a $10 million umbrella on the ground lease alone. I mean, so there were some incremental insurance costs. And, in hindsight, I made a mistake from the beginning. I should have just gone for a max LTV bridge loan, considering how fast I was planning on taking it out anyway. But you live and learn.
Love it. Raj, question for you. So you'll send me your deals and you'll ask me for quotes. And one time it's a 150 unit deal. Next time it's a 200 unit deal. The next time it's a 7 property portfolio made up of 40, 50 units, but like just not the traditional 1 or 2 buildings of 150 to 200 units. So obviously you're diversifying to a certain extent in terms of the exact type of property you're looking at. At what point do you go for the traditional garden style multi-family complex? And at what point do you go to the smaller stuff and you see some benefit there? Is it just what the broker sent you, or you have 2 models and you're specifically diversifying?
That's a great question.
Why do you like that? What talks to you about that?
Sure. So first of all, I mean, it'll be opportunistic in our local markets. I mean, if a broker sends us, or if, again, we have a seller who comes out to us and it's a portfolio or it's a garden style apartment complex, if the numbers make sense in those 2 realms, we're looking at both of them. And I would love both of them in their own right. I do have a soft spot for the portfolio, though, and this is just through experience, in the sense that that's how I built up my own portfolio in some north of Worcester, Massachusetts markets. And it took me a while to do it, and I was slowly but surely building up these smaller multifamilies. And then when we started doing some larger deals, all I had to do was 1031 off, maybe a couple triplexes, and getting some serious equity into the bigger deal. And then I do a couple there, a couple here, and that's all turning into 50, 60, 70 unit buildings that I can own outright. I mean, I'm not necessarily needing to raise, and if we do, it's for a smaller amount and if the deal's that juicy, then it's worthwhile. So having that success and seeing that happen, and now when we see these portfolios and we can get them at a very attractive basis, that's the thought process that comes into my head. I mean, the cash flows and everything are usually, outstanding, especially at the cost basis that we're getting them at. But it's also, well, what does this look like 5 years down the road? can I split off chunks of this and turn it into something bigger that will end up being a longer term legacy hold for me? And so that's why I personally have seen that in these portfolios, and that's kind of where my head goes. And then that being said, the garden style apartment complex, that might be the end game hold that I just, get that off of some of these smaller ones and call it a day. So
I love that. I don't know why I didn't realize that, but essentially what you're saying, Raj, and tell me if I'm being correct in this, it's a feeder. The smaller stuff feeds into the big stuff. And I like that. That's pretty cool.
I call it a treasure chest. That's what I like to call
chest.
it. A little treasure chest, yeah.
I love it. And can you just closed a nice deal, I think it was last week. Can you give us a little bit of insight on that deal, why you like that deal?
Yeah, so it was, like I mentioned, portfolio style, 30 unit. That one we were able to, smaller deal, outsized returns in a market that we really like, a little bit east of Worcester in Massachusetts. And, we're able to raise for that. It's going to be a 5-year hold. We're looking at really strong returns for the investors. So it's essentially going to be, it's like an 11 pref and 25% average annual return in 5 years for the LPs. And then, we're doing quite well on that as well. So I really like that one just because it was kind of how we were talking before. It's like you get a deal, you kind of have the money lined up already, put them together, let's go. And then, as you know, we have another smaller deal closing in a couple of weeks. And it's the same kind of thing. We had the deal, we put the money together on that, and that helps. Now, one that we closed earlier in the summer, that 50 unit, that's one that we had a 1031 on some smaller stuff, and we were able to close on that in one of our markets that we really like. You were able to unlock a lot of money for us on the depreciation from the cost seg. So super excited about it.
Yeah, thank you for the opportunity. Awesome. Steven, I think the last deal you closed, tell me if I'm correct, was in Louisville, Kentucky. Is that correct?
Yes. Louisville, Kentucky. Yes.
Okay, let's talk about that one.
There.
How's that deal going? Why do you like that deal? Why do you like the Louisville market? And can you see yourself continuing to pursue that market?
Sure. So it's not Louisville. I learned that after visiting many times.
Really? What is it? Louisville?
No, so everybody outside calls it Louisville, but when you live there, it's called Louisville.
Louisville.
Louisville. Right. Everyone else says Louisville.
Okay.
As a kid, it's Louisville Slugger. Louisville. King Louis, I think, right? But it's Louisville. I love the market there. Got there. I had a business relationship with somebody with other property outside of Kentucky, and he owned there. He owned there for a long time. I used to follow him down there and started looking at some deals there. Very happy with it. Very happy with the market. Great workforce housing market. Lots of jobs. Lots of logistical types of jobs. Trucking, very centrally located in the country. At one point, every Amazon package you ever got came from Kentucky, if you remember, before they had all those trucks. That's because it's like a 2-hour flight to just about 60% of the population, up to Maine, Florida, I guess West Texas, and the Dakotas, and just a great area for workforce housing. The kinds of properties we own are Class C property. There's always a market for that, regardless of the economy. We do have some Section 8 housing. We're not buying Section 8 property, but we do have tenants or large swaths of tenants that are coming with their own voucher. The market is good there. Vacancies are filled up pretty fast. A lot of jobs there. There is some competition. There are some new properties being developed there, but we love the market, and we're looking for more over there. The jobs market's very well. The few years that we're there, the rents went up a big amount. There's lots of lists out there, but on one of those, Louisville is on the top as far as rent growth in the last year or two. It's been very good to us, and we like it very much.
Love it. I learned something on the podcast today. Tell me if I'm getting this right. Louisville. Okay. Maybe that's why all the folks from there were hanging the phone at me. They're like, "No, you don't know this market. You're calling it Louisville." I'll start saying Louisville.
It's okay. Most of the owners are out-of-towners anyways, and they probably call it Louisville also.
Guys, good stuff. This was awesome. The way we end the show is by going through each and every one of you, giving us a piece of advice to a newbie investor and an aha moment, a moment in your career where you could have went right or left. You could have thrown in the towel, or you used that momentum, or wherever it was, or that lesson to be like, hey, doubling down and going all in. Doesn't have to be too profound or fancy, but if there's any sort of something that has happened that could inspire our listeners. So Ben, let's start with you. A piece of advice to a newbie investor and an aha moment in your career.
My piece of advice would be to avoid maybe the temptation to scale too quickly. Take it slow, be meticulous in your analysis, really try to understand both the asset class and the market where you are investing in, because it's very easy to get excited and to go on a semi acquisition spree based on maybe back of the envelope math and not really knowing the market that well. And it could turn out okay, but it could turn out poorly. I started this company about in, I think late 2018, and around in 2021, 2022 is when my now partner Matt Rinklin from GCM Grosvenor, who's a $4 billion fund manager, came on, and he had actually built that fund from scratch within a much larger asset management firm, and he's almost like an insurance policy for me in that, like, I know if he's very conservative, if he's going along with it, then I can't be taking too much risk. And just having him on and just having someone to just bounce ideas off of on a confidential level is so important. Two heads are better than one. And yeah, I would say from that point on, we've really gone into overdrive.
Love it. I like what you said. To bounce ideas off somebody on a confidential level, somebody that you could actually trust. He's not going to steal your ideas, and you could go far together. Raj, a piece of advice to a newbie investor and a turning point in your career.
Yeah, sure. So as far as a piece of advice goes, I mean, we say it all the time. It's like the people that show up to work every day and the people that answer their phones at any hour of the day. Isaac, you're a perfect example of that. I can call you at 8 a.m., 8 p.m., midnight. I haven't done that yet, but may happen soon. And I know you're going to be there and answer the phone. So, hard work is a cliche, but I think it's true. I think you need to show up. You need to be held accountable for things you're doing, especially once you build out a team. Like, you're the one that people are depending on, and you need to make sure that you're setting a good example. I have a family. I go on vacations. I do things like that. But I mean, if your phone's got to be with you, and if you're the kind of person who thinks you can check out on a vacation, I mean, that's not what happens in this business. You need to, again, you got to be held accountable, and time kills deals. You can go and take those vacations and not answer your phone. Just don't expect that the deal's going to get done, and somebody else might win it because you weren't there. So we don't let that happen, and that's something that I guess it's just kind of always been there with me, kind of coming up. And now looking back on things and kind of reflecting, that's something that I can say that's part of the reason why there's been some success here is because we show up. And then as far as the aha moment, I mean, I think there's a couple. The big one is that, like, around everyone else around, like, the COVID time, it's the migrations and where's everyone going, and we did the same thing. We looked at South Carolina. We liked South Carolina, and we had success in South Carolina. And in the at the same time, we were also doing our Massachusetts thing, and because we already had that, and we were able to grow that quickly while still keeping eyes on South Carolina. Once we exited that market, and we saw what was happening because we already had the foundation in Massachusetts. It made us realize, and that aha moment for us was the micro. You need that. You need to be a master. Not everyone needs it. We needed it, and it made us be successful. Is having that kind of micro strategy, really understanding our markets, and then that's how you're able to gain confidence for other people. And when you're going to ask for their money, it's look how invested we are in this market. Look how much we know about this market. Look at the selling points about, for us, the limited supply, the workforce housing demand, and so that was something that when we figured that we could be successful there, and there's all these reasons why that we can pass that on. So that was one of the aha moments, and then to mirror what Ben said as well is the partnership thinking. So when I started, I was doing a lot of it solo, and I wasn't thinking big enough. And then I brought my partner on, Chris Morgan. A shout out to Chris. He's been great in kind of helping me think bigger. And now, again, to Ben's point, bouncing ideas off of each other every day. It's a strategy session. What deals are we doing? Who are we talking to for other deals? And allocating roles and really just crushing our roles. And I think that without that, I don't think I'd be where I'm at today. And I think he'd say the same. So the partnership mentality, which sometimes you're like, oh, let's keep it all to myself. But then, like, without that other half, you're probably limiting yourself. So
Love it. Love it. Good stuff. Good stuff, Raj. Steven, last but not least, advice to a newbie investor and a turning point in your career.
Sure. So over the years, like I said, I'm doing this since '01, and I've had a lot of people, just ask me real estate advice. And, over the course of my career, some of that advice changed. At this point, I would probably break that advice down to, depending on who I'm talking to. So, if I'm talking to a young guy who's working, not necessarily a career, but just working, making some money, I'd probably tell him, try to buy something small on your own, get involved, manage the property, see if you like it, see if you could raise, make money on it. If the person is, a young guy or, making some money with a career, I would probably tell him to become an LP into a few different deals. Don't stick with one GP. Spread the money around. Try to, ask for the minimum amounts and, learn it that way. See how different people operate, different deals. And then from there, try to figure out what you want to do as far as to take it to the next level. But as an entry, I would definitely recommend those two. Definitely get involved somehow or another. If you could buy something small, buy it. Buy a 3-family house a half hour away from where you live, manage it. Once you own it, the numbers start clicking about equity and loan pay down and all that type of stuff, and it really opens your mind when you're actually in the game. At the same time, if you're LPing into deals, you could be the smallest LP, but you could get the GP on the phone, you could text him, you could ask him questions, and it becomes a resource. So I can invest a small amount into Raj and Ben's fund and almost get them on speed dial on a Sunday morning if I have a question or advice about something. So there's definitely value to that. As far as an aha moment, I've had quite a few. I invested in certain areas I didn't like, even though I'm born and raised in New York. I'm afraid of New York. I own my primary home here, obviously, and I own this, where I'm sitting, the office building, but I don't really invest in New York, and I learned the hard way. I did own some property here, so it was an aha moment on different areas. But I'm going to go back to what both of you guys said with the partners. For most of my career, I was a solo operator. Buying, I was the secret sauce. Whatever I said goes, and nobody to bounce ideas off of. I took a partner about 7-8 years ago, Michael Eisner. Shout out to him. And with that, like you guys said, I get to constantly bounce ideas off, obviously in confidence, and I'm confident in our conversations as well. It's really a game changer. Two minds greater than one. It really took me, I guess, to the next level, and it was really a game changer. Another aha moment was, you mentioned it before, networking. I love to network. It's hard to quantify, every meeting, but it is profitable if you do it and if you do it well. Of course, I know Isaac from networking. He even came by and sorry, the plug over here, and dropped us off. It has his
We
face
got
on
the
it.
bottle. We got the
Yeah,
bottle
yeah.
here.
So I'm gonna take care of this after the podcast. I know it's only 10 a.m. over here. Networking is key. It leads to a lot. Just to give an example, on Sunday, we spoke about Sunday phone calls. On Sunday, I had a conference call with somebody who I met at an event who mentioned my name to somebody else. And I was on the phone with an owner of a small portfolio of properties in one of the markets that I own. It was a Sunday morning phone call and came because of, some meeting I went to, some cocktail event I went to. I'm not sure it was the top golf that Isaac hosted the other day, but that was great, by the way.
We missed Ben.
But
Ben was supposed to be there. He's going to come to the next one. Raj is too far away, but I think Ben was on the way. But he got to turn around to his attorney's office for the $8.5 million deal. We'll get him next
okay.
time.
He's excused. Yeah, so networking is definitely one of my aha moments.
Wow. Love it. Guys, thank you so much for coming on. Folks in the audience listening to this, these guys are the real deal, doing some beautiful stuff. Get in touch with them. Signing off.
Hey everyone, thank you so much for tuning in to the Stage Debate podcast. This was a fun one. Appreciate you guys tuning in. Definitely connect with me on LinkedIn, get a hold of me. Let's talk podcast, let's talk COSAG. Subscribe and get notified for all future episodes. Thank you and have a great day.